Our guest tonight says the U.S. economy's performance so far is uneven. She's Lindsey Piegza. She's chief economist at Sterne Agee. You know, Lindsey, at the beginning of the year, there was so much optimism about the U.S. economy, about the global economy. And aside from what's going on with the weather, it seems like right now there's so much of a mood of gloom and doom. You know, what's your take on the economy? How would you describe the health of it right now?
I think right now the best way to describe the U.S. economy is uneven. We're seeing a strong juxtaposition between some sectors that are holding their own, holding steady, juxtaposed with extreme weakness, particularly in the consumer sector. Now, remember, volatility quarter to quarter, the consumer is still spending at just a very stagnant 2% pace. So that doesn't necessarily bode well for a trajectory pushing us above a 2% GDP pace as we roll further into 2014.
And how much does the weather play in all of that? Lindsey, I know they often use it as an excuse, but let's face it, we've had an extreme winter in the eastern part of the country, and there is an historic drought in California right now.
You're exactly right. An extreme winter can have a very negative impact on the economy. When we look at manufacturing, it can impede capacity. When we look at the consumer, it can really limit foot traffic out spending money in the marketplace. But if we look at this morning's service sector index, we actually saw that employment picked up. So looking forward to Friday's employment report, it's going to be difficult to explain away all of the weakness, if there is weakness, simply because of the weather.
So let's talk a little bit about the employment report. There is a lot of anxiety about that Friday number. What are you expecting? Is it going to be a good number? Is it going to be a bad number? And how's that going to play out?
We're actually looking for about 130,000. So it's not necessarily the devastating number that we saw in December, but it's also a far cry from the trajectory of momentum that we saw in October and November with those back-to-back plus 200,000 non-farm payroll reports. Now, what's interesting about Friday's report is the market is very likely to not react quite as dramatically as it would if we see an upside or downside report, simply because there's going to be a lot of excuses about the weather playing into that number. So we really won't get a clean number until the February report.
I learned long ago that the stock market is not the economy, but it does try to figure out what the economy is going to do down the road. We had a tough month of January. It's been a very tough month to begin with for February for the U.S. stock market. Is it trying to tell us something about the economy this year?
Well, it's interesting because going into the end of 2013, the stock market was really driven by animal spirits. Consumers were feeling much more confident. We had energy price reprieve. We had certainty in Washington. We had these temporary wealth effects boosting consumer spending. But now as we turn the corner into January, especially following that very disappointing December report, I think some of that optimism has been shot as we now focus more on reality and those underlying fundamentals, which tell us that we're not seeing the job and income growth we need in order to sustain this recovery going forward.
All right, Lindsey, thanks a lot for coming on the program. Really appreciate it.
My pleasure. Thanks so much.
Lindsey Piegza from Sterne Agee.